Bitcoin is the world's first asset with absolute mathematical scarcity. This scarcity can be verified by any member of the network and is governed by an algorithm written into Bitcoin's source code. Miners who create blocks can use this algorithm to receive newly minted Bitcoin. This subsidy assists miners in meeting the high costs of mining. The algorithm, however, cuts the subsidy in half every 4 years in an event known as the halving. This process will continue until around the year 2140, when the rate of new Bitcoin will drop to 0 Satoshi per block. Miner revenue is roughly cut in half when a halving occurs. A 50% drop in revenue, as in any industry, can force a company out of business. Mining directly provides security to the network in the case of Bitcoin, so flight of miners from the network could jeopardize Bitcoin's security model. Bitcoin skeptics believe that as the block subsidy approaches zero, low miner revenue will lead to lower security and a diminishing value proposition for Bitcoin itself. Skeptics are also concerned about a deflationary currency. As Bitcoin's inflation rate falls, some economists claim that there will be insufficient Bitcoin to support a monetary system, and that Bitcoin will never support retail payments due to its high price. In this video we will address both of these concerns. But first, subscribe to our YouTube channel so you don't miss out on things worth knowing. Okay, let's jump into the video. Concerns about network security. The total amount of mining taking place on the network, as measured by hash rate, provides a rough estimate of the security of Bitcoin's blockchain at any given time. As block subsidies decline, miners' revenue is jeopardized, and Bitcoin's security appears to be jeopardized. Several factors, however, combine to allow miners to continue mining profitably while maintaining Bitcoin's security despite a halving. Fees for transactions. To begin, miner revenue is made up of the block subsidy, the newly minted Bitcoin, plus the total transaction fees paid in a block. This sum is known as the block reward. As a result, while the block subsidy is reduced by half, transaction fees are not, and the block reward is reduced by less than half. As Bitcoin adoption grows, so will demand to transact on the network, and fees are expected to rise to compensate miners. This is due to the fact that only a limited number of transactions can be confirmed every 10 minutes. As a result, transactors must bid in order for their transactions to be confirmed in a timely manner. Innovation. Second, Bitcoin mining technology is advancing at a breakneck pace. Since their introduction around 2013, ASICS, the special microchips that miners use to mine as efficiently as possible, have seen rapid improvements. If a miner can increase the energy efficiency of their mining operation while lowering costs, they will be able to offset a portion of the revenue lost due to the halving. Energy is less expensive. Third, while energy prices vary over time and geography, the cost of energy, the most significant component of a miner's operating expenses, is generally declining. If a miner can reduce their energy costs over a 4-year period, they can sustain a revenue loss without having to shut down. It should be noted that miners typically do not pay the consumer rate for energy. As large customers, typical mining operations can negotiate more directly with providers to obtain the cheapest energy possible. Furthermore, Bitcoin mining is not geographically restricted. A miner is free to locate their operations wherever the cheapest energy is available. This enables miners to operate in remote locations that would be unsuitable for other types of businesses, such as an oil field or near a hydroelectric dam. Difficulty modifications. Fourth, due to the difficulty adjustment algorithm in Bitcoin, a miner's expected revenue is dependent on their relative share of the total Bitcoin hash rate. As a result, if other miners are forced to close due to the halving, miners who manage to stay profitable should see higher returns because their relative share of the total hash rate has increased. The difficulty of mining decreases as the total hash rate decreases. A halving can increase profitability for miners who continue to mine by weeding out competition and increasing their chances of finding a block and claiming the reward. Price increases. Finally, an increase in the value of Bitcoin can convert a loss in Bitcoin-denominated revenue into a gain in fiat-denominated revenue. The vast majority of miners still pay their costs in fiat currency, so their fiat-denominated revenue is more important to them than their Bitcoin-denominated revenue. As a result, if the price of Bitcoin doubles over a 4-year period, a miner can sustain a 50% drop in the block subsidy without losing any fiat revenue. This last factor is especially important, as halvings push the Bitcoin price higher. Because the halving reduces the supply of new Bitcoin entering the market, if demand remains constant, the simple mechanics of supply and demand dictate that the price rise. Indeed, over the first 12 years of Bitcoin's existence, this theory has come to fruition. Between the previous 3 halvings, the Bitcoin price in US dollars increased by at least 900%, more than compensating miners for the 50% drop in Bitcoin-denominated revenue. All of these factors work together to keep miner participation and network security up after a halving. In fact, previous halvings had no discernible effect on hash rate. On the contrary, the Bitcoin hash rate has continued to set new records. As the block subsidy approaches zero, transaction fees will account for an increasing proportion of the block reward. Miner revenue, and thus Bitcoin security, will become completely dependent on these fees. Skeptics have expressed doubts about the fees' ability to maintain adequate levels of security. While this is a valid concern, the Bitcoin network's continued popularity and utility demonstrate that a mature fee market is possible. While transaction fees for transacting on the blockchain are expected to rise, not all Bitcoin transactions must be settled to the blockchain. Additional layers, such as the Lightning Network, enable cheaper and faster Bitcoin transfers. Concerns about money. As Bitcoin's inflation rate is cut in half every 4 years, it will gradually become the world's most difficult currency. Bitcoin's inflation rate fell from 3.7% to 1.8% during the most recent halving, when the block subsidy was reduced from 12.5 BTC to 6.25 BTC, making it less inflationary than the stated US dollar inflation target of 2%. The 2024 halving will make Bitcoin less inflationary than even gold, which has long been valued for its low stock-to-flow ratio. Many economists are concerned about the effects of deflationary money on the economy. They would argue that Bitcoin's deflationary policy will leave insufficient money in the financial system and will cause interest rates to rise too high, stifling growth. Satoshi Nakamoto designed each Bitcoin to be divisible into 100 million pieces in order to address the perceived problem of lack of money in a system. These pieces are known as Satoshis, and a Satoshi is worth $0.000437 if the Bitcoin price is $43,700. As the value of Bitcoin rises and more people use it, smaller and smaller pieces of Bitcoin will have greater and greater purchasing power. As the value of Bitcoin rises, so will the value of goods denominated in Bitcoin. As a result, the total amount of Bitcoin in the system is unimportant. Rather, it is the purchasing power of each Satoshi that is important. Concerning deflation, most Bitcoin supporters believe that concerns about Bitcoin causing a deflationary spiral and suffocating demand for goods are exaggerated. Fiat currency, as an inflationary money, has incentivized people to spend their money now rather than save it for later. Bitcoin, on the other hand, encourages long-term investment rather than short-term consumption. No human, however, can reduce their consumption to zero. As a result, Bitcoin would not devastate an economy's demand. Rather, it will shift demand from current goods to future goods. Certain industries that sell frivolous, short-term goods may suffer from Bitcoin's deflationary pressure, but others, such as the tech sector, would thrive. In fact, the technology sector has been subjected to significant deflationary pressure over the last 30 years. While the quality, variety, and utility of these devices have increased, the price of televisions, phones, and computers has remained flat or fallen. Despite the deflation, consumers around the world have continued to buy devices in ever-increasing quantities. What's your opinion on Bitcoin? Is it here to stay? Let us know down in the comments and subscribe to our channel. Thanks.